Okay, Hiren Ved now joins us. He represents Alchemy Capital. Hiren, good morning. Fantastic to have you back. Thank you for joining us. Hiren, let's identify the madness to the market, the method to the market madness. Is it only about liquidity which is making the markets look good? And is liquidity the only reason why markets are trading where they are?
Look, Nikunj, I think for any market, I think liquidity is very, very important. There is no doubt about that, right? And my view is that liquidity cannot be the only reason. I think the market's also responding to the fact that there is a gradual recovery and opening up of the economy. And, India is not the only country where the markets have gone up. So it's in many senses a global phenomena. And we must not forget that Indian markets were recovering even while FIs were selling in this market, right? So I think that, the phase one of the markets was where we corrected because of the lockdowns and the fear of uncertainty. And thereafter, I think as global stimulus and opening up of the economy was put in play, I think the markets have responded in their own wisdom. And we just can't hang the hat of liquidity. The market's wisdom is far beyond just liquidity. So yes, liquidity is important, but my sense is that markets are looking ahead rather than looking behind.
Why are markets convinced, Hiren, the future is bright? Because there is enough empirical data which says that private sector capex will not pick up. NPA is a huge concern for banks when moratorium will get lifted. With an exception of few digital companies here or there, every sector is going to slow down. So if the future is uncertain, what is making markets excited?
See, Nikunj, we should first understand that when we call what we call the markets is basically the index, the narrow index and probably even the broader index, right? I think the markets have the ability to filter out companies which will not grow or survive because of the current challenges, right? And we've seen this that there are several companies and sectors which today trade at prices which are even pre-COVID, right? So I think that capex was not happening was a fact even pre-COVID. So there is nothing new about the fact. In fact, we were as an economy slowing down even before COVID happened. So I think what we have done is that we've kind of retraced 70-80% of pre-COVID levels. And the challenge for growth even remains going forward from here. But I think what the markets are also representing is the consolidation that is happening across sectors, right? Where there are companies, and especially all over the world, the indexes are being driven by large mega caps who have a larger representation in the index and who are seen as survivors and somebody who will thrive in the post-COVID era. So I think we need to differentiate when we call market and the fact that there is continuous consolidation that is happening in the markets. And, there are fewer companies which continue to drive the so-called index.
Fair point. Now, Hiren, stock price is a function of EPS into PE. Let's talk about both the aspect and let's split it into two. Where do you think EPS, which is earnings, will grow and earnings will contract?
So I think if you look at an aggregate level, Nikunj, I think, you won't get the right picture of earnings because clearly there are some sectors where earnings will contract, right? So your consumer discretionary will contract. You may have financials this year which have taken extra provisions fearing an NPL loss in the second and third quarter their earnings may contract as opposed to what we were thinking that earnings would rise. So I think FY21 clearly will be an earnings contraction here at an aggregate level, right? So while some companies will grow earnings, but many of them will see contraction of earnings, right? And I don't think that current market prices are only going by FY21 earnings numbers, because clearly the value of a business is the present value of the longer term cash flows and profitability of a business. And I think that therefore the markets are willing to overlook the current contraction in earnings in FY21. So at an aggregate level, yes, there will be a contraction, but I think the markets are saying that this is a one-time phenomena and we are willing to move on.
Okay, the second part, PE, which is a function of liquidity and perception. There are some parts of the market where PE multiples are at levels at which they are not going to sustain, whether it's a Nestle or a DMart or even an HUL. There are some ends of the market where PE multiples are so smashed down in some of the steel stocks, cement stocks, PSUs, that they cannot contract a bit more. So where do you see in the market now there could be a change of perception? Because PE is nothing else but it is perception at the end of the day.
See, Nikunj, there are, I would say that there are two parts when you look at PE, right? At a very aggregate level, I think PEs are also a function of interest rates in the economy. And I think that, this argument was something that was discussed over the last 3-4 years, that even though we had very anemic earnings growth, we still saw the markets going up, we still saw the P's going up in response to falling cost of capital. And I think in India now, for the first time, cost of capital again continues to fall. And we've seen that the 10-year has come down, post-COVID. And therefore, I think that there is a case in general for P's to sustain because the cost of capital continues to come down. Secondly, I think it's, as you rightly said, it's also about where the market sees incremental growth and visibility. So I think given that there is an X amount of liquidity which is going into this asset class, right, it is quite likely that the P's in sectors will continue to be high, where the volatility in earnings and the certainty of earnings, at least in the near term, is higher. And therefore, one might argue that some of these franchises are very, very expensive. But I think unless there is complete clarity and visibility as to how the broader economy is recovering, I think that P's of companies, which are where the earnings visibility is generally high and the volatility in earnings is low, will continue to remain high for some time at least.
Have your top 3 holdings changed, Hiren, because of the COVID era?
Well, I think they've changed because some of them obviously have corrected substantially. And as I mentioned, that there are sectors which have not corrected. So clearly, if you have exposure to pharma or consumer or telecom, then there the valuations have actually gone up rather than going down, even as the markets corrected and moved back up. So yes, I think that, clearly there are some sectors which have benefited and actually are trading at prices which are higher than pre-COVID levels. And that's what the reflection is as far as portfolios are concerned as well.
Hiren, where do you think franchises like Bajaj Finance are headed? In the long term, they would be big beneficiary of what is happening to NBFC, market share gain, data advantage. But in the short term, they will have to slow down the growth. So do you think a franchise like HDFC Bank, Bajaj Finance, AO Financials, will they also feel the heat of rich valuations?
See, I think, Nikunj, clearly, when we talk about some of these leading financials, one must understand that the valuations that they had were a combination of growth and the ROE and the opportunity that was there ahead of them, right? I think that opportunity continues to exist. The fact that some of these businesses will continue to benefit disproportionately because of market share gains also exists and is true. I think what has changed in the near term, at least, is that most people argue that the liability side of the balance sheet of these businesses will be good. And I agree that there is, I think they've managed the liability side extremely well. I think the challenge is on the asset side in the current cycle, right? And the challenges on the asset side is very, very significant. First of all, we do not know what is the exact level of NPLs that will hit these balance sheets. Yes, all of them have proactively gone and raising capital in order to fortify their balance sheets. And yes, in the near term, I do believe that growth is also likely to be impacted. So I think that in the near term, there would be a challenge in terms of valuations. But longer term, if these businesses are able to maintain their ROEs and the opportunity exists, then I do not see why these valuations will not come back, but they may come back with a lag. I think once the markets are convinced that this is the extent of loss that the business would have to take, and they have provided for that. And then if once growth comes back, I think then then these franchises will probably start to trade at multiples that we had earlier. But yes, I think at least in the medium term, we can't expect them to go back to the earlier multiples that they were at, because those were times of hyper growth. And I don't think those hyper growth years are coming back in a hurry, at least not in the short to medium term.
Hiren, are you tempted to take a deep dive in a BEL or a BHEL or a SAIL? Because some of these stocks now have potential of getting re-rated, because if the BPCL divestment goes through, then the importance of some of these PSUs could automatically be realized, and then everybody will start assuming, speculating, or even it may also happen that some of these PSUs could be sold.
Yeah, true, Nikunj. I think some of these stocks definitely have very deep value. But we must also understand that there have been many of false starts in this process, right? And I think the overall risk, wherever the valuation unlocking is based on a particular event, continues to be there. There could be delays. There could be unforeseen events which could derail some of these. While I think this time it looks like that the government is very, very serious about divestment and privatization, and I think that's very good overall from an economy perspective. I think it still becomes very, very difficult for somebody like us to take a call on these businesses, no matter how attractive and cheap they look, because there is always an element of doubt, and I think that the experience of investors have not been very pleasant in the past, trying to play event risks, and very clearly we don't play event risks like those, and therefore they may constitute an opportunity in the marketplace, but I think it's for investors who can take that uncertainty along the way. But I take your point that there could be an opportunity if the government is able to demonstrate by doing a BPCL divestment. I think there could be a huge rating or massive re-rating of the PSUs, because then investors will start valuing these businesses closer to their fair values.
Hiren, everyone knows that we would be spending much more on pharmaceutical to stay fit, to increase our immunity, and even governments all over the world will have to invest on the infrastructure. Now, as percentage of GDP, both locally and globally, we are going to see a huge expansion or explosion of healthcare spending. How can investors really participate and make money in this mega trend?
See, I think, Nikunj, there are two aspects. One is that obviously the COVID crisis has brought in a lot of focus on general well-being and healthcare and so on and so forth. But I think the big opportunity as a result of this crisis is really on the export front. I think that people have realized and the world has realized that they need to, they need to be Atmanirbhar. And given the fact that with the kind of narrative that is going around the world with respect to China, I think that India is going to be a big beneficiary of some of these supply chains shifting. I mean, clearly, India has shown that there is a competitive strength that we have in the generic area, in the API space. And I think this will only increase going forward from here because of COVID and because of the dispersion of supply chains that is likely to happen. So I think the export opportunity is likely to come back very, very significantly. Yes, overall spending on health in this country is only likely to go up in one direction as health insurance picks up in a big way in this country. And as the government starts to spend more and more on healthcare, I think there is an opportunity in India as well. But we must be mindful of one risk that all governments around the world, right, tend to intervene wanting to bring prices down. And sometimes these pricing decisions could hurt profitability of companies. So, while we have to be mindful of those risks, I think overall as a sector, very clearly, it looks like that it is one of the contenders for leadership, in the next bull market for sure. And I think the export opportunity is very real and can be quite significant for the Indian pharma industry.
So let's talk about specifics. What are you doing? Are you buying hospitals? Are you buying diagnostics? Are you buying generic companies? What has Hiren Ved bought?
So Nikunj, we've not bought hospitals. We don't have exposure to diagnostics, but we do definitely have exposure to leading pharma companies who are both very strong in APIs as well as who are strong in the US as well as the Indian markets, right? I think in general, pharma companies who have a broader exposure to emerging markets, to India, as well as in the US, and who have strong backward integration capabilities like API, I think that is where we've placed our bets in. Hospitals could be interesting, but, we still grapple with the fact that those are relatively low ROCE businesses. And again, currently, I think there is a lot of pressure on the healthcare system in India to deliver care at very, very reasonable prices. So I'm not sure whether, hospitals would be the right way to play this trend. But I think very clearly, in my opinion, I think pharmaceuticals, API manufacturers is where we think the scalability and the profitability and the return on capital is probably the highest. So that's the end of the market that we would want to play, where we think that there is a clear opportunity and there exist scale advantages already in place for these companies to grow even bigger.
Where are you buying the beaten down or broken down pieces of sectors which have got directly hit because of COVID? For example, tourism or hospitality or aviation. Are you going against the trend there, Hiren? And let me supplement my point. If a vaccine is going to be discovered in the next 6 to 12 months, then some of these sectors which have taken a huge hit can almost come back to normalcy very quickly.
Yeah, Nikunj, I think we haven't obviously, those are areas or good hunting grounds to look for sectors where valuations are very, very beaten down. But we must understand that aviation has always been a very, very difficult sector, right, to make money. And yes, the industry has consolidated clearly, but I think that there could still be challenges in that sector. But there is a last man standing syndrome, which we may be able to play in the aviation sector. But I think it's still, in my opinion, there is still some time before one goes ahead and starts to participate there. In my opinion, some of these people who will definitely survive may also need to raise more equity. So I think the right time to look at some of these is when they come out and start to raise equity, because they will have to fortify their balance sheets. Also, because clearly current operating cash flows are very, very challenged for these businesses. So yes, these businesses will bounce back, but I think there will be opportunities to look for these businesses as they come to the markets to raise additional capital.
You mentioned last time that you believe in the importance of platform companies. Now, India has a couple of platform companies, India Mart, MCX, India Energy Exchange, even BSE can be called as a platform company. Where are you picking your spots in the platform business?
So, Nikunj, we do have exposure to one of the large commodity exchanges. I think that platform businesses have a very bright future because they are capital light. And once they achieve leadership, I think there could be an opportunity to make money there. And I think that there will be opportunities. There are also new platforms which are being created. For example, in financial services, brokerages which have an online platform where they are able to give integrated services. I think that industry was anyway consolidated. I see more consolidation happening in favor of some of these platforms which are very, very tech savvy. And therefore, there will be an opportunity. There will be a new set of leaders who will emerge out of this. And we all know that participation has gone up significantly over the last 3-4 months. It's an inflection point for some of these platforms, and they will clearly grow multifold from here onwards as more and more tech savvy and younger customers try to access various parts of the markets using these platforms. So yes, it's quite interesting in my opinion. I think this crisis is clearly an inflection point for some of these businesses to break out and grow into much bigger companies from where they were today. It's like what happened to the payment companies after demonetization, right? They got a big push. The environment was just right, and I think platform companies have a lot to look forward to going forward from here.
Hiren, let's understand the psyche of an equity investor. You want gold, which is considered to be an indicator of risk aversion, is at an all-time high or nearing at an all-time high. Internationally, India, it is an all-time high. You got equities which are considered to be the ultimate proxy of gold, is also at an all-time high. So for someone who's looking at asset allocation, you would say, I don't know what's happening. How come risk and risk aversion, they both are going up at the same time?
Yeah, it's quite an interesting question here, Nikunj, that both equities and gold, are moving up in the same direction, right? I think gold is going up more because whenever there are times of uncertainty, and also with the kind of massive stimulus that has been injected into the economies worldwide, is likely to debase the currencies, the printed money. I think that's what's been happening with every crisis, that we are printing more and more money. Interest rates are becoming low to negative, and therefore, gold, while it's an unproductive investment, but as a store of value, keeps going up. So when you have this amount of money printing that happens around the world, gold is an asset that people go to, right? As far as equities is concerned, I think especially here, I think it's the only productive asset which can still give you a positive yield or return, right? Because clearly long-term interest rates are headed down and are likely to remain down for a long, long period of time. So I think that debt investments are unlikely to give you those real returns. And I think real returns can only be had from equities, because inherently companies generate cash flows and profitability, and they tend to beat inflation and nominal growth rates. So I think it's more a reflection of the fact that in one case, the asset class like gold is responding to massive liquidity and the fact that inflation expectations are very, very low. On the other hand, equities is an asset class which reflects the ability to give you, some kind of a absolute return over long periods of time, because companies tend to generate cash flows and profitability, which will protect your capital and grow it over a period of time, right? And I think we continue to see that dichotomy. And unfortunately, in this world where where more and more debt is being racked up around the world, the risk reward of investing in fixed income just keeps deteriorating over a period of time. And I think the benefit of that is actually going to equities and gold as an asset class.
Well, Hiren, fantastic to have you back, and thank you for this wonderful insights. Viewers, in a sense, I'm sure would benefit from some of your key takeaways. Stay safe, and hope to certainly see much more of you going forward.
Thanks, Nikunj. Thanks for having me. Bye-bye.